Why do we love the SOBR stop? This is Bill Scheid from Applied Finance Research, and that's the question we're going to look at in this video. So first of all, let's talk about the SOBR stop and what the systems are like without it. So our monthly asset allocation systems produce excellent results without the SOBR stop. However, without the SOBR stop, the systems have only the end of month time-based stop. And one of the things that may make some investors uncomfortable with that is that as market volatility increases over time, that increases the risk to our monthly systems, or really to any systems that aren't designed to be volatility adaptive. So for example, during the COVID crash, that was the fastest 30% drop by the S&P 500 in stock market history. And my belief is that we're going to see an increase in global market volatility over time as the world becomes more interconnected, as information flows faster, as there are more machine and algorithmic traders, and I think due to a number of other factors as well. So some investors may not feel comfortable having only an end of month stop that doesn't take volatility into account. So one of the other options is to use a trailing stop. That's a very popular idea in trading and has been for a long time. The consideration with trailing stops is that yes, they do decrease drawdown, but they also materially reduce return. And we've seen that in our research with these monthly asset allocation systems. And I also got a chance to hear Perry Kaufman speak recently. Perry Kaufman is a very well-known researcher and investor. He presented at the London Society of Technical Analysts, and he found the same results, that for long-term systems, trailing stops do decrease the drawdown, but they also materially reduce return. And it makes sense if you think about it. Long-term systems are trying to catch long-term trends, and yes, markets do pull back in the short term, but if we can hang in for the long term, then we end up making good results. So trailing stops may not be the most effective for these type of systems. So then the question becomes, well, what do we do? Which is why the SOBR stop is such an excellent solution. So with the SOBR stops, our monthly systems then have two stops. So that would be the end of month stop plus the volatility based SOBR stop. As our friends overseas like to say, they would call that belt and braces, or in the States here we say belt and suspenders. So we have two different ways of exiting our positions for a little bit of extra security. And because the SOBR stop uses volatility instead of price, it's not so easily able to get picked off. You know, sometimes price levels where stops are often placed can be interesting targets for market makers and scalpers to try to run some stops and create some advantageous market moves for themselves at the expense of others. We're not using price levels, we're using volatility, so it helps to avoid that problem. And there's no special indicator required for the SOBR stops. The information involved in SOBR stops is easily available on any public information platform like Yahoo Finance, Google, the stocks app on your Apple device, etc., etc. So there's no subscriptions, no extra cost, really easy to track that one. And best of all, it improves the results when paired with our optional short entries. So here is a look at some of the results that I'm talking about there. This is a back test of our momentum system BMR21. And let's take a look at what we have. So we have three columns here. Basically, we have the S&P, we have our standard BMR21, and then we have it with our SOBR stop and short positions. We have total return, maximum drawdown, compounded annual growth rate, worst period, and return to drawdown ratio. So we can see that the standard system, without any stops except for the end of month stop, has fantastic performance, and it totally beats S&P on pretty much all of these metrics here. Return to drawdown ratios, outstanding, much better than SPY. Excellent total return, maximum drawdown, much less than SPY. excellent compounded annual growth rate, and a much lower worst period. Now, when we add the SOBR stop and the shorts, the results get even better. 960% total return on a maximum drawdown of only minus 15%, compounded annual growth rate of 16%, worst period minus 9.2, and a return to drawdown ratio of 61.1. So why do we love the SOBR stop? These are all the reasons. Thank you very much for watching, and happy investing.